already paid the tax on that money. And now he's got to pay another $580,000 to the Inland Revenue. I can stop all of that if I just put it into trust at the point that I passed. Don't want simple wills. Okay, inheritance tax. Briefly go through this. $325,000, that is your lifetime allowance. Individually, $325,000, it's not much. It's not much. And it's frozen until April 2028. So it's not going to increase from that, it's not going to decrease from that. $325,000 as an individual. As a married couple, obviously that doubles up, because again, the inheritance tax isn't paid until second death. So $650 as a married couple. Now, the residence nil rate band. Okay, so the residence nil rate band was introduced in 2017. And the reason it was introduced was because the government felt that a lot of people were being pulled into paying inheritance tax based on the value of their property. So depending on where you lived in the country, as it were, your property has probably increased in value quite substantially. So they thought, well, actually, people are actually just being sucked into paying inheritance tax here just purely on the basis of the value of their property increasing, as it were. So what they did is, back in 2007, they phased it in over 5 years. They introduced another allowance, which is called the residence nil rate band. It currently sits at $175,000 each. So as a husband and wife, you've got $175,000 each. So as a total now, you've got $500,000 each. So £1 million as a married couple now, before your estate will pay any inheritance tax. But there's always a catch to it. Always. They like to give it to you one hand and take it away with another. So first one, you must own a residential home that you live in. That's key. You must live in the thing. So it's all very well not having renting a house or whatever, but I've got a buy-to-let over here. That doesn't work. You've got to live in the house. You've also got to have children, lineal descendants. You've got to have children that you're ultimately leaving that house to. And the total estate value, not just the house, but your total estate value, business shares, cash in the bank, property, whatever it is, must be below £2 million. That's crucial, because it tapers away at £1 for every £2 that you're over the 2 million mark. So as a married couple at 2.35 million, you've lost it altogether. And now you're back down to your 650. Yeah? So the idea of any inheritance tax planning is to try and get you to that 2 million mark. That's the idea of all the planning, as it were, because then we've got, we're there. We can claim for the residence nil rate band. Yes, you're still going to pay a bit of inheritance tax at 2 million, as you'll see in a sec, but it's going to be, you're going to get that enhanced allowance. Quite important. Generational inheritance tax. So this is what I was talking about before. So when you have a simple basic will and you're passing those assets directly to the next line of beneficiaries. Yeah, if I pay inheritance tax today, when I pass, my wife and I are both passed, we've got a £2 million estate for argument's sake, I pass away, I'm going to pay inheritance tax on that money. So £2 million estate, I've got £650,000 as a lifetime allowance between my husband and I, because again, it's not paid until second death. And we both qualify for the residence nil rate band as well, because we've got a property and our total value of estate is below, or is at 2 million or below. So my net estate is £1 million. I'm going to pay inheritance tax on that £1 million, because I've had £1 million that's been taken off. That's my allowance. The government are giving me that. Thank you very much. Appreciate that. But I've got to pay £1 million. Or I've got to pay inheritance tax on £1 million, and I'm going to pay 40%. Absolute daylight robbery, because I've already paid the tax on that money. This is a double taxation. This now, yeah. I've already paid the tax on that money already, and now I'm being charged, just because I've died, 40% on that £1 million. Yeah? So I'm going to pay £400,000 in inheritance tax when I pass away. Well, when my wife and I pass away on that £2 million. Not great. My beneficiary was my son, okay? My son. So this is purely basic will stuff now, not with the trust stuff. I'll explain that in a sec. Purely basic will. This is me just passing the assets on. So what I've done now is I've passed over to my son. So my son at the moment, he's got a house valued at 450,000, and he's got savings of 50,000. So he's got 500,000. He hasn't even got an inheritance tax liability at the moment. Hasn't even got an inheritance tax liability at the moment. 500 grand estate. Perfect. Until I died.
If you want to find out how to buy a business successfully, get your free business buying toolkit. The link is in the video description below.
Now, my son, I paid my 400,000. Here you go, son. £1.6 million. There you go. It's all yours. Oh dear. My son's estate now has increased to £2.1 million. Oh dear. Now he has got an inheritance tax liability. Yeah? He doesn't qualify for the residence nil rate band either, because he's now over the 2 million. Chances are he's going to continue to increase the size of his estate because he's still quite young. He's only got 650,000 as an allowance between him and his wife. That's it. Yeah? So there's an estate valued at 2.1 million. He's got 650,000 that's coming off of it. So net estate, £1.4 million. 40%, it's going to pay 580,000 in inheritance tax. Again, remember, he didn't even have an inheritance tax liability again. So this is now coming off the money that I already earned. I've already given him that money, as it were. I've already paid the tax on that money. And now he's got to pay another 580,000 to the Inland Revenue, as it were, purely because I just gave him it through a simple basic will. Now, had I put that money, there you go, so he's paid £980,000 in 2 generations of my original £2 million. Crazy, absolutely crazy. But people don't understand this. This is the problem. And that's why when we have simple basic wills, this is real life. This is what happens when you have simple basic, because you're just passing the assets on. You're not really thinking about the tax element of it at all. But it's a real issue. So poor old grandson, he only gets just over £1 million of the original 2 million he gets. Not great. And again, the whole thing starts again now. If my son only had a basic will, I'm now passing that just over £1 million to my grandson. I'm already creating him an inheritance tax liability, so whatever he does in his lifetime, we're only going to pay it again for a 3rd time, and a 4th time, and so on and so on and so on. But I can stop all of that if I just put it into trust at the point that I passed. If I put it into trust and I loan that money, so if I went back to my son here, so I paid the 400,000. That's important. I'll pay the 400,000. I'm happy to do it. Well, I'm not happy to do it, but I'll do it, as it were. But then the £1.6 million, if I put that into trust when we both passed away, and that £1.6 million I named my son as a beneficiary to the trust, that £1.6 million wouldn't even enter into my son's estate. So he's only going to pay inheritance tax on the bit that he actually creates himself, not a gain on the assets that I've created. Massively, massively important. So we always want assets ultimately to be falling into trust at the point that you pass. Yeah? Don't want simple wills. Not in this day and age. Not in this day and age. So what can we do about mitigating some inheritance? This is just simple solution stuff. You're looking at gifting solutions. Yeah, so gifting directly to beneficiaries. We don't really want to do that again either. Again, same thing. So if I've got, 50 grand that I want to give to my son, as it were, so he can buy his first house, the last thing I want to do is just give him 50 grand. Because if I just give him the 50 grand, I've lost control of it, first of all, because I've given it to him. It then sits within his estate. If he's buying a house with his girlfriend and they decide to split up at that point, the chances of me getting my 50 grand back, not on impossible. Probably not going to happen at all. So I might as well just kiss that money goodbye. So what I would do is I would set up what they call a gift trust, and I would inject the cash into that gift trust, and I would loan that 50 grand to my son, so he can then go and buy a property, do whatever he wants to do. But if anything happens at that point, they decide to split up, the money comes back to my gift trust. Now, all the time that I have no benefit from the gift, and this is really important, no benefit from the gift whatsoever, after 7 years, the value of the gift that I made is outside of my estate. But as a trustee, I can still be in control of the money, but I cannot benefit from it. But I can control the money still, so I can recall the loan if I want, if it's through the trust. So that's gifting solution. Never just give the cash away. Never. Always do it through a gift trust.
Buying a business is a roller coaster, which is why you need a lawyer who knows what he is doing. So why not use mine? His name is John Andrews, and you can find his contact details below this video.
Again, with a gift trust, I can gift every 7 years up to my lifetime allowance, $325,000. To put more into a discretionary gift trust during lifetime, I'm going to pay 20%, so half of the death rate on any value above the 325, and then I'm also into what they call periodic charges territory as well. So every 10 years, I'm going to pay 6% on any value over that 325,000. So we would only ever let you put a maximum of 325,000 into it every 7 years. At the end of the 7 years, it's outside of the estate, you could put another 325,000 into it. And as a husband and wife, you can do 2. So you could do 650,000 out of your estate every 7 years, fully protected. Okay, business relief. So if you've got a trading business that's there to make a profit and you've owned that business for a minimum of 2 years and you pass away, chances are that you'll qualify, your shares in that business will qualify for what they call business relief, which means that they'll be inheritance tax free. Fantastic. Now, things like property businesses, for instance, that's more of an investment business. So investment businesses don't qualify for business relief. Okay, so again, in this situation, if you've got businesses that would potentially qualify for business relief, as part of your structure that we would put together for you, we would add a business trust in there to hold those business shares, again, outside of your estate so that your beneficiaries can benefit from your business shares but not have that liability again. Yeah, really quite important. So that's one thing that we would always add into your business. It's the same with agriculture as well. So if you've got a farm, so again, a great mitigation for inheritance tax is for you to go and buy a farm. Yeah, because again, farms qualify for agricultural relief. Yeah, inheritance tax free. As long as we're putting it into the trusts and bits and pieces. We don't want to just pass them directly on to the kids, as it were. Yeah. So you also have an annual allowance. I know it's not much, $3,000 a year that you can just give away. And give it away to the kids or whatever. You have to put it down in your self-assessment tax return, as it were, that it's your annual allowance for £3,000. But as a husband and wife, that can be 6,000. But you can also go back 1 year as well. So you could do 12,000 as a husband and wife in the first year of doing it. You can also gift surplus income as well. I don't know if you know that as well. So if you've got, for instance, I don't know, $5,000 a month coming in, but you can show that you can support your standard of living, as it were, on $3,000 a month, well then that 2,000 additional you could just give away if you wanted to. Again, no 7-year rule on that. Yeah, so any surplus income can be given away. 10% to charities. So if you put within your will that I'm prepared to leave 10% of the value of my estate, then the government will go, well, that's great, that's really charitable of you. We'll let you, we'll reduce your inheritance tax liability down to 36%. Yeah, but you've got to give away 10%, obviously, to benefit from that. So, but again, some people do quite like that. And the other one, just spend it. Just have a good time. You've earned it. Just spend it. Have a good time. Absolutely, it's what I'm intending to do, for sure. Absolutely, for sure. Because if I don't, chances are I'm only going to pay a fair amount of tax on it. So I might as well have a good time in the meantime.